Welcome to today's lecture. Good day, everyone. I'm glad to see you all here and ready to dive into another key topic in accounting. Today, we're talking about accounts payable and accounts receivable. These are two super important concepts that come up whenever a business handles credit transactions. Before we jump in, let me set the stage for why this is worth your attention. Why should you care about this? First of all, this is something that will absolutely show up in your exams. You'll be expected to know what accounts payable and accounts receivable are, how they're recorded, and how they relate to the accounting equation. It's not just about memorizing definitions. You need to understand how these work in real-life scenarios. But it's not just for exams. Whether you end up managing a business, working in finance, or just handling your own accounts, understanding these concepts will make your life so much easier. So let's dig in. Take some notes and feel free to ask me questions if anything isn't clear. Let's start with the basics. What are credit transactions? When we talk about credit transactions, we mean situations where payment doesn't happen right away. Instead, the business or the customer agrees to settle the amount later. Think of it like a promise. You either owe money to someone, that's accounts payable, or someone owes money to you, that's accounts receivable. This promise forms the basis of these two accounts. Easy enough so far, right? What is accounts payable? Okay, let's focus on the first type, accounts payable. This comes into play when a business buys goods or services on credit. Picture this. You run a flower shop and you need to stock up on vases. Your supplier delivers the vases to you, but instead of paying them immediately, you agree to pay next month. That unpaid amount is what we call accounts payable. Here's why it's important. Accounts payable is recorded as a liability in your books. Why? Because it's money you owe. It's an obligation. Once you pay your supplier, the amount gets cleared. Your cash balance decreases and the liability disappears from your records. Think of accounts payable like a financial IOU. Until you pay it off, it's a reminder that your business has a debt to settle. What is accounts receivable? Now let's flip the script. This time, imagine your flower shop sells $500 worth of flowers to a customer. But instead of paying up front, the customer says, "I'll pay you next week." That $500 becomes your accounts receivable. Why? Because it's money that's owed to you. Your business provided a service or product, so you're entitled to collect that payment. Here's the key to remember. Accounts receivable is recorded as an asset. Why? Because it represents money that will eventually come into your business. It adds value. Once the customer pays you, your cash balance increases, and the accounts receivable is cleared from your books. It's like the reverse of accounts payable. Instead of owing someone, someone owes you. How are they different? Let me put it in simpler terms. If your business owes money, that's accounts payable. If someone owes money to your business, that's accounts receivable. Payable equals money going out. Receivable equals money coming in. The biggest difference is how they're recorded in your books. Accounts payable is a liability because it represents money you owe to others. Accounts receivable is an asset because it represents money owed to you. Let's use a quick example. Let's stick with our flower shop example to see how this works. Imagine you buy $200 worth of flower pots from a supplier on credit. You haven't paid yet, so this creates an accounts payable of $200. It's recorded as a liability because it's money you need to pay. When you pay the $200, your cash decreases, and the accounts payable is cleared. Now, let's say you sell $500 worth of flowers to a customer on credit. The customer hasn't paid yet, so this creates an accounts receivable of $500. It's recorded as an asset because it's money you expect to collect. When the customer pays the $500, your cash increases and the accounts receivable is cleared. Easy enough? You're either paying someone or getting paid. It's all about keeping track of the timing. Why does this matter in the exam? Here's where it ties into your exams. You'll often be asked to calculate values related to accounts payable and accounts receivable, or figure out how they fit into the accounting equation. Remember this. The basic accounting equation is assets equals capital plus liabilities. Accounts receivable affects the assets side because it adds value to your business. Accounts payable affects the liabilities side because it's something your business owes. If you can understand how these two fit into the equation, you'll be prepared for any related question. Final thoughts. Before we wrap up, let me remind you why this is important. These concepts are central to how businesses track money coming in and going out. They help you keep your finances organized and balanced. And yes, they'll show up in your exams, so mastering them now will make your life easier later. So as you study, keep asking yourself, is this something the business owes, or is it something owed to the business? An account payable is a person or a business that a company owes money to because it purchased something on credit. That's it. It's that straightforward. For example, imagine you run a flower shop. You buy a bunch of potted plants from a supplier, but decide to pay for them later. In this case, the supplier becomes your account payable. From an accounting perspective, accounts payable is always recorded as a liability. Why? Because it represents money your business is obligated to pay in the future. It's a debt, plain and simple, and accounting helps you track it so you don't lose sight of your financial commitments. Let's talk about trade accounts payable. Now here's a term you'll hear often in accounting. Trade accounts payable. It sounds fancy, but it's just a specific type of account payable. These are debts that arise directly from the business's trading activities. Basically, the things you buy to keep your business running. Let me give you a few examples of what might fall under trade accounts payable. Materials you need to create products. Components for assembling goods. Items you purchase to resell, like flowers or gift items in a shop. So, going back to our flower shop example, if you buy flowers from a wholesaler to sell to your customers, the money you owe to the wholesaler is a trade account payable. It's directly tied to your business operations, unlike, say, a loan you might take out for equipment. That would fall under a different category of liability. The role of credit terms in business. Now let's talk about something that's a common practice in business. Credit terms. When you buy on credit, you and your supplier agree on a specific date by which you'll make the payment. This arrangement is helpful because it allows you to get the goods or services you need right away without spending your cash immediately. Here's how it typically works. The supplier delivers the goods and sends an invoice with a payment deadline. The deadline might be something like 30 days from the purchase date, or even 2 or 3 months. This is a win-win situation. You get time to manage your cash flow, and the supplier knows exactly when they'll receive their payment. Let's walk through a real-life example. To make this crystal clear, let's go over the example from your book. The transaction. Company A buys goods from Company B for $2,000 on credit. Company B sends an invoice dated March 1st, which says payment is due in 30 days. What happens if payment is delayed? If Company A doesn't pay until March 31st, Company B remains an account payable for Company A during this time. How is this recorded? This part is where the accounting comes in. For Company A, the $2,000 they owe is recorded as an accounts payable in their books because it's a liability. For Company B, the same $2,000 is recorded as an accounts receivable because it's money they expect to receive. It's an asset for them. Why are accounts payable so important in business? Let's step back for a moment and talk about why accounts payable matter so much. These aren't just numbers in a ledger. They're tools for managing your business effectively. Helps manage cash flow. Think about it. By delaying payments to suppliers, a business can use its available cash for other things, like paying salaries, covering rent, or even investing in growth opportunities. Accounts payable essentially act as a short-term loan from your suppliers, giving you breathing room to manage your finances. Maintains good supplier relationships. Here's another important point. Paying your suppliers on time is crucial for building trust. Suppliers are more likely to offer favorable terms and continue doing business with you if they know you're reliable. That's why staying on top of your accounts payable is a must for any business owner. A quick note on invoices. Finally, let's touch on something we'll dive deeper into later. Invoices. An invoice is basically a bill that the supplier sends you, showing how much you owe and when payment is due. Invoices are the backbone of tracking accounts payable because they provide all the details, like the amount, the due date, and even any penalties for late payment. We'll talk more about invoices in an upcoming chapter, but for now, just remember that they're a critical tool for managing accounts payable. What is accounts receivable? Let's start with the basics. Accounts receivable refers to the money that a person or another business owes to your business because they bought something from you on credit. It's what you're waiting to collect after you've already provided goods or services. Think of it this way. If you sell something to a customer but let them pay later, the amount they owe you is called accounts receivable. Here's why it's important. Accounts receivable is considered an asset in accounting. Why? Because it's money your business expects to receive in the future. Even though you don't have the cash yet, your right to collect it makes it valuable to your business. What about trade accounts receivable? Now let's get more specific. A trade account receivable is a type of accounts receivable that comes directly from your business's normal day-to-day operations. For example, if you run a flower shop and sell flowers on credit to a customer, the money they owe you is a trade account receivable. It's tied to the main business activity, selling goods or services. This is different from other types of receivables, like if someone owed you money for renting a piece of equipment. That's not tied to your regular business activities, so it wouldn't be classified as a trade account receivable. Why is accounts receivable considered an asset? Let's make this crystal clear. In accounting, an asset is something valuable that your business owns. Even though the money from accounts receivable hasn't landed in your bank account yet, it's still considered an asset. Why? Because you have a legal right to collect that payment. It's something of value to your business. So, when you look at a balance sheet, accounts receivable will always appear under the assets section, right alongside things like cash and inventory. Let's walk through a real-life example. Here's a practical example straight from your book to help you see how accounts receivable works. The sale on credit. Business C sells goods worth $6,000 to customer D. The terms of the sale specify that the payment is due in 2 months. The invoice is dated October 1st, so the due date is November 30th. What happens next? Between October 1 and November 30, the $6,000 will be recorded in Business C's books as accounts receivable. If customer D doesn't pay by November 30th, the $6,000 will remain as accounts receivable until it's settled. Recording it in the books. Here's how it's handled in accounting. For Business C, the $6,000 recorded as an asset under accounts receivable because it's money the business expects to receive. For customer D, the same $6,000 is recorded as a liability in their books because it's money they owe. Notice how these two sides match up? What's an asset for one business is a liability for the other. Comparing accounts receivable to accounts payable. Now, let's take a moment to compare accounts receivable to accounts payable. These two concepts often come up together, so it's important to see how they're different. Definition. Accounts receivable is money owed to your business by customers. Accounts payable is money your business owes to suppliers. Type of account. Accounts receivable is an asset because it's money you expect to receive. Accounts payable is a liability because it's money you're obligated to pay. Examples. Selling goods on credit creates accounts receivable. Buying goods on credit creates accounts payable. Where they appear. Accounts receivable shows up on the assets side of the balance sheet, while accounts payable appears on the liabilities side. Key points to remember about accounts receivable. Let's wrap this up with a few important points about accounts receivable. These are things to keep in mind for exams and for real life. Why does it happen? Businesses often allow customers to buy on credit because it makes it easier for customers to purchase. This can increase sales, which is great for the business. However, it also means the business has to wait to receive payment. Risks involved. Here's the tricky part. If customers don't pay on time, or worse, don't pay at all, the business could face cash flow issues. That's why keeping a close eye on accounts receivable is critical. Many businesses set up systems to remind customers about payments and follow up regularly. Connection to credit transactions. Remember, accounts receivable is part of a larger system of credit transactions. Just like a business buys goods on credit, creating accounts payable, it can sell goods on credit, creating accounts receivable. Both are normal and common in business operations. I know charts can sometimes feel overwhelming, but don't worry. I'll walk you through it step by step, as if we're having a one-on-one conversation. By the end of this, you'll clearly understand the key differences between accounts receivable and accounts payable, and how they're tied to a business's operations. Let's get started. Credit transactions. What's the big picture? This chart explains two common types of transactions that happen when a business deals with credit. 1. Sales on credit, which lead to accounts receivable. 2. Purchases on credit, which lead to accounts payable. These are opposites, but they're two sides of the same coin. One involves money a business is waiting to receive, and the other involves money a business owes. Now let's break it down column by column. First column, sales on credit. When a business sells goods or services to a customer on credit, the customer doesn't pay right away. Instead, they agree to pay later. Here's how that works, step by step. 1. What happens? The business makes a sale. The customer gets the goods or services but delays payment. For example, imagine a flower shop sells $500 worth of flowers to a customer and lets them pay after 30 days. That's a sale on credit. 2. What does this create? This transaction creates an accounts receivable. An accounts receivable is the money owed to the business by the customer. Think of it as a promise of payment that hasn't been fulfilled yet. 3. How is it recorded? In accounting, accounts receivable is recorded as an asset. Why? Because it represents money that the business expects to receive in the future. It's something valuable that adds to the business's worth. 4. When is it settled? This account is settled when the customer pays the money they owe. At that point, the business's cash increases and the accounts receivable decreases. Second column, purchases on credit. Now let's flip to the other side. What happens when a business buys goods or services on credit? Here's the process. 1. What happens? The business buys goods or services from a supplier. Instead of paying immediately, the business agrees to pay later. For example, imagine the same flower shop purchases $300 worth of flower pots from a supplier, but decides to pay the supplier after 60 days. That's a purchase on credit. 2. What does this create? This creates an accounts payable. An accounts payable is the money the business owes to the supplier. It's essentially a promise to pay the supplier at a later date. 3. How is it recorded? In accounting, accounts payable is recorded as a liability. Why? Because it represents money the business is obligated to pay. It's a debt. 4. When is it settled? This account is settled when the business pays the supplier. At that point, the cash decreases and the accounts payable is removed from the books. Key comparison between accounts receivable and accounts payable. Now that we've gone through each side of the chart, let's summarize the main differences. Sales versus purchases. Accounts receivable comes from sales made by the business. Accounts payable comes from purchases made by the business. Who owes whom? Accounts receivable is money owed to the business by customers. Accounts payable is money owed by the business to suppliers. Type of account. Accounts receivable is an asset because it represents money the business expects to receive. Accounts payable is a liability because it represents money the business is obligated to pay. How they're settled. Accounts receivable is settled when the business receives cash from customers. Accounts payable is settled when the business pays cash to suppliers. Why does this matter? Understanding these two types of accounts is crucial because they reflect how businesses handle cash flow. Here's why. Accounts receivable shows the money coming in. It's a measure of what the business is waiting to collect from customers. Accounts payable shows the money going out. It's a measure of what the business owes to others. Both are a natural part of running a business. Balancing them effectively helps ensure the business has enough cash to operate smoothly. That's it. This chart is a handy tool to keep in mind as you study or manage real-life accounting scenarios. If you have questions or want more examples, let me know. Let's keep building your confidence with these concepts. And let's revisit this question about Jackie Dixon and her business. This example is all about understanding how the accounting equation works and how we classify different amounts in Jackie's situation. Let's take it one step at a time. Here's the situation. Jackie has a total of $2,500 of capital invested in her business. Out of this, $1,750 came from Jackie herself, while the remaining $750 is a loan from Barry Grant. The question is, how does this affect the accounting equation? Before we dive into the solution, let's quickly review the accounting equation. Assets equals liabilities plus capital. This equation is the foundation of accounting. Everything the business owns, its assets, must balance with everything it owes, its liabilities, and the owner's investment, its capital. Step-by-step explanation. Step 1. Identify the assets. The first thing we need to figure out is what the business owns. In this case, the business has cash worth $2,500. That's the total value of its assets. Step 2. Break down the liabilities and capital. Now let's figure out how this $2,500 is balanced. It's a mix of liabilities, debts the business owes, and capital, money Jackie has invested as the owner. Jackie's contribution. Jackie invested $1,750 into the business. This amount is classified as capital because it represents the owner's claim on the business's assets. Loan from Barry. The remaining $750 is money the business borrowed from Barry. But here's the important question. How should we classify this? The classification depends on the terms of the agreement between Jackie and Barry, which we'll explore next. Step 3. Understand Barry's role. Barry's $750 could be classified in one of two ways, depending on the arrangement between him and Jackie. Scenario 1. Barry is a partner. If Jackie and Barry are partners in the business, meaning they share the risks, rewards, and profits, then Barry's $750 would be considered capital. Why? Because as a partner, Barry has a stake in the business, just like Jackie. In this case, Jackie's $1,750 and Barry's $750 are both classified as capital. There are no liabilities in this scenario because all of the money comes from the business's owners. So, the equation would look like this. Assets equals capital plus liabilities. Cash worth $2,500 equals capital worth $2,500 plus zero liabilities. Scenario 2. Barry is a lender. On the other hand, if Barry is simply lending the money and has no share in the business's profits, then the $750 would be classified as a liability. Why? Because the business is obligated to repay Barry, likely with interest. In this case, Jackie's $1,750 remains as capital. Barry's $750 is classified as a liability. Now, the equation would look like this. Assets equals capital plus liabilities. Cash worth $2,500 equals capital worth $1,750 plus liabilities worth $750. Final classification. Here's a summary of how the amounts are classified, depending on Barry's role. If Barry is a partner, assets, $2,500. Capital, $2,500, $1,750 from Jackie, plus $750 from Barry. Liabilities, 0. If Barry is a lender, assets, $2,500. Capital, $1,750, Jackie's contribution. Liabilities, $750, Barry's loan. Key takeaways. Let's highlight the key points from this example. 1. The accounting equation must always balance. No matter how the money is classified, the total assets of $2,500 are always equal to the total liabilities and capital. 2. Classification depends on agreements. Barry's role determines whether the $750 is classified as capital if he is a partner or a liability if he is a lender. 3. Capital is a special liability. Jackie's $1,750 is classified as capital. In accounting, this is considered a special type of liability because the business technically owes it back to Jackie as the owner. And that's how we solve this question. That wraps up today's discussion. As always, feel free to ask questions if something isn't clear. Thanks for being such an attentive audience. I know this stuff can seem tricky at first, but the more you practice, the easier it gets. Let's keep building on these concepts together.